Picture yourself waking up one day to the report that the banks have all been shut. You reach for your phone to look at your balance. But the application refuses to open. The cash machine on your street has a handwritten note on it that says, "Not functioning. Stores are still open." But nobody is accepting your credit or debit cards. The gas stations are only taking cash. Your rent is due. But your landlord will not accept a digital transfer. Initially, you might think it's just a technical hiccup, some brief system failure. But then you start to notice the atmosphere on the streets. People are forming long lines outside the closed doors of bank branches. Grocery stores are packed with shoppers whose carts are piled high. And they are all paying with wads of cash because plastic has become worthless. The news channels are broadcasting constant updates. The entire financial system is undergoing an emergency evaluation. Then, the realization hits you with the force of a tidal wave. Your money is not where you believed it was. It's not sitting in your account, waiting for you to take it out. It was never more than a set of numbers on a display. And now, the display has gone blank. This might sound like the beginning of a dystopian story, but it's very real. It has taken place before, and not in some distant, unstable country you barely think about. It has occurred in nations that considered themselves to be modern, stable, and protected. And when this happens, life doesn't just slow down, it breaks. The entire set of rules for wealth and survival changes in an instant. Let's look at Argentina in the year 2001. Following years of poor economic decisions, mounting debt, and bailouts from the IMF, the government was in a desperate situation. The banks were losing deposits at an alarming rate as people scrambled to exchange their pesos for dollars and send them out of the country. In response, the government bolted the gates shut. They gave it a name, the corralito, which means the little corral, for everyday Argentinians. However, it felt like a prison. Cash withdrawals were limited to a mere 250 pesos per week. Bank accounts held in dollars were mandatorily swapped for devalued pesos. In a matter of weeks, savings that were intended for buying homes, starting businesses, or funding retirement lost half of their actual value. People took to the streets, banging pots and pans in protest. Middle-class families who had always felt secure and stable were suddenly plunged into total chaos. That is precisely what unfolds when banks are closed. Your money vanishes, not in some theoretical way, but in the sense that bread, milk, and rent suddenly become things you can no longer afford. And Argentina was not an isolated case. Consider Cyprus in 2013. The European Union compelled the government to put a freeze on bank deposits as a condition of a bailout package. Ordinary account holders woke up one morning to find out that any account with over 100,000 euros would be directly levied, literally confiscated, to help save the failing banks. The billionaires were not the ones who felt the most pain. It was the small businesses that could no longer meet payroll, the retirees who were cut off from their pensions, and the parents who could no longer pay for their children's education. In Lebanon, starting in 2019, years of government corruption and financial meltdown led to the imposition of capital controls. Banks restricted withdrawals to just a few $100s each month, regardless of the total amount in your account. Frustrated savers began to show up at bank branches, not with withdrawal slips, but with firearms. In every one of these instances, the narrative was identical. The money you believed was yours was actually theirs all along, even in the United States, the country where people say, "It could never happen here." The banks have been shut down before. In 1933, during the worst part of the Great Depression, President Franklin Roosevelt announced a nationwide bank holiday for 4 straight days. Every bank in the nation locked its doors. People could not get cash. Companies could not pay their employees. And a deep sense of uncertainty took hold. It was only after the government performed inspections and allowed select banks to reopen that public trust was gradually restored. But just consider that for a moment. One of the richest nations in the world had to literally put its entire banking system on pause just to stop it from collapsing. The single common element in all of these events is that banks do not hold your money in the way you imagine. They function on a system of fractional reserves. For every single dollar you deposit, only a small portion of it is kept in the vault. The remainder is lent out, invested, or converted into various forms of debt. When an excessive number of people show up asking for their cash all at once, the illusion shatters, and governments, rather than acknowledging their system's weakness, typically choose to side with the banks. They freeze withdrawals. They devalue your savings. They effectively make you bear the cost of the system's failures. Now, try to imagine this scenario playing out tomorrow. In your own town, what would your plan be? Do you have enough cash to last for a week? Or for a month? Could you make your mortgage payment if the bank itself was the source of the problem? Could you put food on the table for your family if those digital numbers on the screen simply disappeared? This isn't about being paranoid. It's about confronting a difficult reality. The financial system is not designed for your protection. It is designed to protect itself. And when it comes under pressure, you will find that banks are not secure vaults, but delicate machines that run on confidence. The moment that confidence breaks, money and power begin to move in ways that are beyond your control. That is the ultimate nightmare, and as we have witnessed from Argentina to Cyprus, from Lebanon to the United States itself, this is not a work of fiction. It is a matter of historical record, and history has a very unpleasant habit of repeating itself. When we examine these crises more closely, the underlying pattern becomes disturbingly apparent. Banks do not fail due to some random stroke of bad luck. They fail because of their fundamental design, the system of fractional reserve banking, which is the foundation of our entire financial world, is both its greatest strength and its most critical weakness. To put it simply, banks don't just store your deposits, waiting for you to come and collect them like a coat from a cloakroom. They take your money and use it to create more money. If you deposit $1,000, the bank might hold on to $50 as a reserve and loan out the remaining $950 to a new business, a family buying a home, or even the government. That loan then becomes a deposit in someone else's account, and a portion of that can be lent out again. From nothing, $1,000 can be transformed into $5,000 or even $10,000 of circulating credit. This process is a powerful engine for economic growth, but it is also a structure built on a precarious foundation, because if too many people arrive at the same time to claim their original $1,000, the bank simply does not have it. This is the reason why public confidence is the most crucial element. The whole system functions smoothly as long as everyone believes that the bank doors will always be open. But the second that trust begins to shake, a bank run can start. It doesn't even require everyone to demand their money, just a sufficient number of people to reveal how thin the layer of actual cash reserves is. And once that sense of panic begins to spread, even financially sound banks can be pushed to the brink of collapse. It's like a fire alarm in a packed theater, a single shout, a single rush toward the exits. And suddenly, survival becomes a frantic stampede. Governments are well aware of this vulnerability. That is why, in one crisis after another, their primary instinct is not to safeguard the individual saver, but to safeguard the banks. When Argentina implemented the corralito, it wasn't an act of pure malice. It was done because if they had permitted people to continue withdrawing their money, the entire banking system would have imploded within a week. When Cyprus used bail-ins, taking depositors' money to shore up the system, it was presented as a necessary, if painful, solution. But the outcome was harsh. Ordinary citizens were made to pay for the blunders of politicians, bankers, and international lenders. In the United States in 1933, Roosevelt wasn't just trying to reassure the public. He was desperately trying to buy enough time to halt a chain reaction of bank failures. The stark truth is that banks and governments are intrinsically linked. Banks rely on governments to maintain public confidence, provide deposit guarantees, and act as a lender of last resort in times of crisis. Governments, in turn, need banks to purchase their bonds, fund their deficits, and direct credit throughout the economy. When a crisis strikes, they instinctively protect each other, and the person who is often left vulnerable is you, the depositor, the taxpayer, the one who is supposed to be the owner of the money. This illusion of safety is reinforced by regulations and insurance programs. Deposit insurance sounds like a solid protection. In the United States, the FDIC guarantees bank accounts up to $250,000. But consider this. If every single depositor in the country tried to claim that guarantee simultaneously, would the funds actually be there? The answer is no. The insurance fund holds only a tiny fraction of total deposits. Its true purpose is psychological. It is a comfort blanket meant to keep you from panicking. And what happens when the banks are shuttered? Commerce screeches to a stop. Digital transactions cease to exist. Paychecks are put on hold. Supply chains break down. In Lebanon, factories were unable to import essential raw materials because they could no longer wire dollars to other countries. During the 2015 crisis in Greece, people stood in long lines at ATMs in the scorching sun, waiting for hours just to withdraw a meagre €60 per day. Weddings were cancelled. Medical procedures were postponed, and children were taken out of school, all because the financial system had determined that access to your own money was no longer a basic right, but a privilege to be carefully rationed. Even in our modern era of smartphones, cryptocurrencies, and fintech innovations, this fundamental problem has not been solved. In many ways, it has become even more acute. The digitization of money has made us more reliant than ever on banks and other centralized platforms. If a server crashes, if a card payment system fails, or if an institution decides to freeze your account, your wealth is suddenly nothing more than digits trapped in a digital void. In a society that is becoming increasingly cashless, the notion of a bank shutdown is not some dusty relic from the Great Depression. It is a modern-day catastrophe waiting to unfold. Now, Consider the wider consequences. Businesses are unable to pay their staff, leading to widespread layoffs. Supermarkets cannot pay their suppliers, so their shelves begin to empty. Investors panic and start selling off their assets at heavily discounted prices, wiping out retirement savings and pensions. The government makes frantic efforts to restore confidence. But with each passing day, the lines get longer and people's patience wears thinner. What started as a technical decision made in a corporate boardroom quickly escalates into a major social crisis. And the longer it continues, the more desperate people become, resorting to bartering, hoarding essential goods, and even rioting. This is not just a theoretical exercise. It has occurred in countries all over the world. It could happen again. And if you believe it could never happen in a place like America, Britain, or Germany, just remember, those were the exact sentiments expressed in Argentina in 2000, in Greece in 2010, and in Lebanon in 2018. Stability is just an illusion until the day it shatters. The uncomfortable fact is this: the primary purpose of banks is not to protect your wealth. Their purpose is to protect themselves and the broader system they are part of. When faced with a crisis, they will sacrifice your interests to ensure their own survival. The system is designed this way, and to pretend otherwise is the most perilous mistake you can make. If this has offered you a fresh point of view, please subscribe. History holds the answers, and I will guide you to where you can find them.